So imagine you're trying to solve uh, literally the most complex, high-stakes crisis in human history.
Right.
And you open this vault to see how much money you have to fight it. But you realize you can't actually count the cash.
Yeah, it's completely opaque.
Exactly.
Yeah.
Like, you ask one accountant and they tell you, okay, there's $23 billion sitting here. But then you ask another accountant looking at the exact same vault and they say, no, you actually have $102 billion.
Which is just a staggering difference.
It's insane. Where did that $80 billion go?
Well, it's a massive discrepancy, obviously, and it points to this foundational crack in the system. Because when you look at climate and nature finance right now, that missing 80 billion, it isn't an accounting error.
No.
It's really a symptom of a market that doesn't even know what it's selling anymore.
And that vault scenario is exactly what we're unpacking for you today. So welcome to the deep dive.
Glad to be here.
We are super eager to decipher this kind of silent tectonic shift happening right now in how billions of dollars are deployed for the environment. Because if you've been following the climate space, you know the old playbook.
Oh, yeah. Originate a green project, throw capital at it, and...
Issue a really glossy press release.
Exactly.
But senior practitioners in nature-based solutions are suddenly waking up to this terrifying reality. Deal origination just isn't the priority anymore.
Not at all.
Actually measuring nature, like verifying the underlying infrastructure of these assets, is suddenly the only thing that matters.
Yeah, and to really map out how this shift is playing out, we're synthesizing some pretty critical intelligence for you today.
We've got a great stack of sources.
We do. I'm looking at a May 2026 industry briefing. It's called The Climate Nature Nexus in Practice, and we're crossing that with the latest synthesis reports from the journal Science.
Super highly regarded.
Absolutely. Plus the UN Environment Programme's State of Finance for Nature 2026 report, and some heavily peer-reviewed data on green bonds and carbon sinks.
Right, so let's start with the money. And specifically, that $80 billion gap we just mentioned, because I think it perfectly explains the paralysis in the market right now.
It really does.
I mean, World Environment Day just wrapped up on June 5th in Baku. And the UN's Secretary General basically confirmed we've hit the 11 hottest years on record.
Yeah, and a temporary overshoot of that 1.5-degree warming target is practically baked in at this point.
Which is a terrifying thought. But the urgency couldn't be clearer. Yet the outcome in Baku was incredibly revealing, right?
It was, because we saw basically zero landmark financial transactions.
Right. No mega deals.
No new flagship capital facilities announced at all. Which, for a sector that has spent the last 5 years screaming that its main bottleneck was mobilizing capital.
You'd expect a flurry of activity.
Exactly. But the fact that nothing materialized tells us we've shifted out of that mobilizing phase and squarely into a diagnostic one. The major players have just hit the brakes.
Because they literally can't trust the numbers. I mean, I was digging into that UN Environment Program report, a UMP one, and they strictly tally private finance for what they call nature-based solutions.
Right, the narrow definition.
Exactly, and they arrive at about $23.4 billion for 2023. But then you look at what's floating around in, like, investor pitch decks, and everyone is leveraging this $102 billion figure.
Yeah, the MSCI number.
Right, a number generated by the UNEP Finance Initiative and popularized by MSCI. So you have two UN-affiliated sources off by a factor of 4.
And the reason they're off is because of this massive definitional chasm.
Break that down for us.
Sure. So the $23 billion figure is a highly restricted, narrow look. It's money flowing directly into verified interventions. So things like actively restoring a specific coastal wetland or legally protecting a defined peatland.
Okay, very tangible stuff.
Right. But the $102 billion figure is just this giant net cast over anything broadly nature badged.
I see.
Yeah, so that includes massive biodiversity ETFs, exchange-traded funds, and highly complex sovereign debt conversions. And in those instruments, the actual flow of capital to the ground is incredibly hard to track.
It's like trying to underwrite a mortgage, right? Where one bank appraises the actual structural integrity of the house.
Right, the foundation, the roof.
Exactly, the square footage. But the other bank is appraising the vague concept of the neighborhood's vibe. And they're just like throwing in the value of the public park down the street.
That is a perfect analogy.
Because if you're an investor, you just can't price risk on a vibe.
You absolutely cannot. And this fourfold gap proves the market just lacks a shared decision grade definition.
Okay, so let's unpack this. Because if you're a senior practitioner, Your rate-limiting step isn't finding attractive land anymore.
No, it's the measurement layer, the verification.
Right. If you can't reliably measure it, you can't safely fund it. You need a metric that means the exact same thing to a pension fund in London as it does to an asset manager in Tokyo.
The metric itself is becoming the primary product. That's a huge shift here.
The metric is the product. I love that.
Yeah.
Which means the industry has to pivot from just originating projects to verifying infrastructure. But UNAP says we need roughly $571 billion a year by 2030.
Yeah, which we are nowhere close to.
Right. So how do we actually fix this definitional chasm? How is the industry creating these decision-grade metrics?
Well, they're building what the Task Force on Nature-Related Financial Disclosures and groups like Nature Finance call a data stack.
A data stack.
Yeah, because for nature to be as comparable and tradable as carbon became a decade ago, investors are requiring practitioners to layer 3 highly specific data sets.
Okay, what are they?
You need impact data, dependency data, and spatially explicit location data.
Wait, here's where it gets really interesting. Let's break those down because impact data makes sense to me. That's just how a company's operations affect the local ecosystem, right?
Right, the harm they might cause.
But dependency data, that feels like an entirely different lens.
It is. It shifts the focus from environmental harm to direct financial risk. It measures how much a business actually relies on a functioning ecosystem just to survive.
Give me an example of that.
Think of a major semiconductor manufacturer. They require millions of gallons of ultra-pure water to fabricate microchips.
Oh, wow. Right.
Yeah, so if the local watershed degrades because of, say, deforestation upstream, their factory literally shuts down.
So that water table isn't just a nice-to-have environmental metric.
Exactly. It's a core financial dependency. If an investor doesn't have that data, they are flying completely blind to the physical risks embedded in their portfolio.
That makes total sense. And then you add the third layer,
Yeah.
right? Spatially explicit location data.
Right. You can't just wave your hands and say, oh, we operate in Brazil.
Yeah, that's way too vague.
Way too vague. You have to provide the exact geospatial coordinates of your operations and your entire supply chain.
So investors can cross-reference it with, like, satellite imaging of deforestation.
Exactly, or water stress. And this data stack fundamentally changes the barrier to entry, especially in instruments like green bonds.
Okay, I really want to pull on that thread because we've seen a massive surge in green bonds. But that 2024 peer-reviewed study we looked at highlights severe structural greenwashing risks there.
Huge risks, yeah.
Because a bond is essentially just a giant loan, right?
Mm-hmm.
A government or a company borrows money and promises to pay it back. And in a green bond, there's a legal clause, the use of proceeds clause, dictating what the money can be spent on.
Right.
So if the use of proceeds says, planting 1 million trees, why does that bond fail just because it lacks the specific data stack? Isn't a tree just a tree?
Well, in a financial market, a tree is a living asset subject to compounding variables.
Okay.
If an issuer doesn't embed explicit nature metrics and ecological safeguards into that clause, the money might just fund a fast-growing monoculture plantation.
Like a massive grid of eucalyptus trees or something.
Exactly. And yeah, they sequester carbon rapidly, but they also drain local water tables. They destroy indigenous biodiversity.
Oh, I see.
Or maybe those trees are planted in a region where historical models predict severe drought in 5 years. Without the geospatial data verifying it, that green bond might deliver literally 0 additional environmental benefit.
The label is basically meaningless without the receipt.
Basically, yeah.
Which leads directly to this framework from the University of Utah research team that I found just fascinating. They outline a credibility ladder for achieving genuine net cooling.
Yes, this is crucial.
You have to climb 4 very strict rungs to prove your nature-based asset is actually bankable.
Let's walk through those rungs because they really do represent the new gold standard. The first rung is additionality.
Meaning you have to prove this wouldn't have happened anyway.
Exactly, beyond a shadow of a doubt. You can't just buy a forest that was already sitting safely inside a protected national park and claim you saved it.
Right, that's just taking credit for nothing. Okay, the second rung is leakage control. I like to call this the whack-a-mole problem.
That's a great way to put it.
Because how do you definitively prove that paying a logging company not to cut down Forest A didn't just incentivize them to drive their bulldozers 10 miles down the road and clear-cut Forest B?
Right, and you prove it through that spatial data stack we just talked about. You don't just monitor your specific project area. You have to run regional baseline adjustments and satellite monitoring of the adjacent landscapes to make sure the destruction didn't just, leak over the border.
Okay, but the third rung is where I think the math gets incredibly demanding. Durability, measured over a minimum of 100 years.
Yep, 100 years.
I have to pause there. A century. We are talking about biological assets living in an inherently chaotic, warming climate. Financial markets operate on, what, quarterly earnings reports? Maybe 10-year bond yields.
Yeah, 10 to 30 years max, usually.
Right. So demanding a century of guaranteed survival seems wildly disconnected from how money usually moves.
It's a radically long time horizon, but it's becoming the absolute baseline because, well, the atmosphere doesn't care about our quarterly earnings.
Obviously not.
If carbon is released back into the air in year 20 because your forest burned down, the climate benefit is negated, period.
Wow.
And that ties into the fourth rung, which is honest biophysical accounting. You can't just measure the carbon a tree soaks up. You have to track how the whole ecosystem interacts with the atmosphere holistically.
Right, like the albedo effect.
Exactly.
For those who don't know, trees in snowy regions actually absorb sunlight that would otherwise reflect off the white snow back into space.
Right, so they can actually cause local warming.
Yeah, if you don't account for that warming effect, your carbon math is basically fraudulent.
And the market is aggressively enforcing these rungs now. Look at the agenda for the upcoming Paris Nature-Based Solutions Congress in November 2026. A full third of their sessions are dedicated entirely to what works.
Just empirical evidence.
Yeah, verifiable evidence of effectiveness. It signals a complete maturation of the industry. Effectiveness measurement is now the absolute prerequisite for liquidity.
You don't get the money until you prove the mechanics.
Exactly.
So what does this all mean for a major corporation? Because once you establish these strict 100-year durability metrics, the traditional way companies engage with these projects completely falls apart, right?
Oh, completely. The synthesis literature in science leaves zero room for ambiguity here. Nature-based solutions are real. They are valuable. We absolutely need them.
Right.
But they can never substitute for the rapid phase out of fossil fuels.
Right, because fossil carbon is different from biological carbon.
Exactly. A ton of fossil carbon pulled from underground and burned is permanent. A ton of carbon stored in a tree is inherently temporary.
So let's map this onto a real-world scenario. Let's say I'm an executive at a major global airline. For the last decade, my strategy was to buy thousands of cheap forest carbon credits so I could slap a carbon-neutral sticker on my flights.
Right, the classic offset model.
Yeah. But with these new standards, I can't do that anymore, can I? I can't say I offset my jet fuel just because I funded a forest.
No, you really can't. The era of the pure offset is dying, and it's being replaced by what we call the contribution claim.
The contribution claim.
Yeah. Moving forward, that airline's public claim has to be bifurcated. They have to say, we are aggressively reducing our internal fossil fuel emissions by investing in sustainable aviation fuel. And D, we separately contributed millions to this verified nature outcome.
On the surface, I mean, offsetting versus contributing just sounds like a semantic PR shift.
It does sound like that, yeah.
But when you look at the mechanics, it actually reprices the entire market, doesn't it?
It drastically reprices it because it removes the permission to pollute premium.
Ah, right.
Under the old model, companies bought credits as a cheap alternative to decarbonizing. Now, if a credit doesn't buy you the right to emit elsewhere, the demand profile changes completely.
They don't want cheap credits anymore.
No, because cheap credits expose them to greenwashing lawsuits. They're buying these as reputation builders and supply chain resilience investments. They want premium, 100-year verified assets.
So the standard shifts from, did we plant the trees, to, will this ecosystem survive the century?
Exactly. Will it survive?
And to really test that question, we have to look at the hardest test cases in the real world. Which brings us to Southeast Asia.
A fascinating region for this.
It really is. Our sources highlight Southeast Asia as the ultimate proving ground for whether these financial structures can actually hold up against physical reality.
Because it represents an incredible concentration of value. The region holds a disproportionate share of the world's most efficient carbon sinks.
The peatlands and mangroves.
Right. The data shows that conserving and restoring those specific ecosystems could mitigate roughly 770 million tons of CO2 equivalent a year.
That is massive.
It's half of the entire region's land use emissions, and it requires utilizing just 5% of the landmass.
5% of the land solving half the emission problem. That's an astonishing leverage point.
It is.
But when we apply that 100-year durability test,
Yep.
the whole equation gets super complicated really fast.
Very complicated. Because of permanence risk. A 2025 spatial analysis in our stack reveals this Staggering reality. Roughly 85% of Southeast Asian mangroves face severe permanence risks.
Wait, 85%?
85%. And we aren't just talking about natural degradation. We're talking active conversion for oil palm plantations, aquaculture farming.
Right, economic pressures.
Yeah, and the physical obliteration of the coastlines by intensifying cyclones and rising sea levels.
It's like, okay, it's like paying a fortune for a state-of-the-art vault to store your gold.
Back to the vault.
Back to the vault. The vault itself is flawless, impenetrable, but then you build it on an actively eroding coastal cliff.
Right.
The vault is great, but the ground underneath it is literally washing into the sea. The permanence risk makes the entire investment entirely unbankable.
That hits the core issue perfectly. Because of this 85% risk factor, blue carbon credits, the ones from coastal ecosystems, are rapidly losing credibility as a standalone financing mechanism.
Investors just won't touch them alone.
Right. You can't buy a 100-year credit and just walk away hoping for the best. To make these bankable, senior practitioners are having to build these long horizon risk structures around them.
So what does that actually look like in practice? How do you financially structure a defense against a cyclone,
Right.
or like an oil palm conglomerate?
You build blended financial layers and parametric insurance wraps.
Okay, let's define those.
Sure. In a blended finance structure, public money or philanthropic capital takes what's called the first loss tranche. They absorb the initial risk, which makes the private capital feel safe enough to actually enter the deal.
Got it.
And then you combine that with a parametric insurance wrap. This is where an insurer agrees that if a cyclone hits a specific category strength in that region, it automatically triggers a payout to restore the mangrove.
Wow, so the physical risk is transferred completely off the investor's balance sheet,
Exactly. It's pushed onto the insurer's balance sheet.
which fundamentally shifts the economics of how we intervene. Because if the physical permanence risk is that high, trying to rebuild a degraded mangrove from scratch is incredibly precarious.
Highly risky.
Yeah, so the math decisively tilts toward protection rather than restoration, right? Paying to actively defend an intact peat swamp and preserve the centuries of soil carbon already locked inside it is far cheaper and way less risky than trying to reconstruct a ruined ecosystem.
Absolutely. And because standalone private projects struggle to carry these immense risks alone, we're seeing a massive migration of capital.
Where's it going?
It's moving away from isolated, project-by-project pilot grants and straight into public balance sheets and systemic government policies.
So the era of the feel-good, isolated NGO pilot project is essentially over.
Essentially, yes.
The verification requirements are just too heavy. We're moving straight into national budgets and insurance wrappers to deal with these risks.
We have to. The scale requires true integration into fiscal policy. One of the mechanisms driving this is ecosystem-based adaptation, or EbA.
Right.
The NMP Global Network is actively embedding EbA directly into national adaptation plans.
Let's clarify EbA for anyone tracking public finance. This is not a conservation grant.
No, not at all.
This is a government deciding that instead of floating a municipal bond to build a $1 billion concrete seawall, they're going to fund the restoration of a barrier reef and a mangrove forest as an official infrastructure line item to absorb storm surges.
Exactly. They're writing nature into sectoral planning for city infrastructure, agriculture, water management. Look at the EU Green Week in 2026. The entire framing shifted toward putting nature finance directly across public budget lines.
And the templates emerging for this are results-based instruments, right?
Yes. Like Indonesia's East Kalimantan emission reduction payments.
I was reading about that one. Under that model, international partners provide initial catalytic payments based strictly on proven, verified emission reductions from forest protection.
Right, proven results.
But the real genius of the structure is that the long-term durability relies on domestic fiscal follow-through.
Exactly. The local government integrates the protection into its own budget once the international payments wind down.
Which means everything is converging at the policy level. You cannot scale nature finance without sovereign governments underwriting the infrastructure.
You really can't.
And this makes the geopolitical landscape incredibly critical, especially as we look toward COP31 in Antalya this coming November 2026.
Definitely. And looking at the macro environment, anyone modeling these capital flows right now has to factor in the U.S. withdrawal from the Paris Agreement.
Right, which, objectively speaking, is a market condition. It fundamentally alters the geopolitical math.
It does.
Multilateral cohesion is fraying, which obviously puts immense pressure on private markets and blended capital to somehow bridge the gap.
Yeah, because the roadmap that came out of the previous COP in Belém calls for $1.3 trillion a year in climate finance
1.3 trillion.
annually. But as we've detailed today, the private capital being asked to fill that void is completely constrained by these rigorous new metrics.
They can't just throw money around anymore.
No. The investors arriving at COP31 are going to be testing whether this painful diagnostic phase, this whole shift from origination to verification, has actually produced a data stack the market can finally trust.
It all connects back to the beginning. That $80 billion measurement gap we talked about, that's the exact same bottleneck holding back the trillions needed at COP31.
Exactly. So if we synthesize everything we've unpacked today, the era of just originating a nature deal, slapping a green label on it, and selling an offset is over.
Dead and gone.
The future of environmental finance belongs entirely to the practitioners who can master the data stack: impact, dependency, and spatial location.
Right.
It belongs to those who can empirically prove 100-year permanence, who can navigate that complex pivot to honest contribution claims, and who really understand how to embed these biological assets into long-term public balance sheets and parametric insurance structures.
Well said. We started today by establishing that rigorous measurement is everything, that the metric is now the product.
Indeed.
But I want to leave you with a final thought to mull over as you explore these markets. We are demanding 100-year durability guarantees for nature. We're demanding that every leaf, root, and albedo effect be perfectly accounted for in a highly engineered data stack.
Right.
But what happens when nature itself, driven by a 1.5-degree temperature overshoot, starts mutating and shifting faster than our financial metrics can predict?
That is the big question.
Right. Can a spreadsheet, no matter how rigorous or sophisticated, truly capture the chaos, the fragility, and the unpredictable resilience of a living ecosystem?
That tension, between financial certainty and biological reality, I think that's the defining question for the next decade of capital deployment.
Absolutely. Thank you so much for joining us on this deep dive into the climate-nature nexus. Keep questioning the data, keep looking for those underlying mechanisms, and keep asking the big questions. We will catch you next time.